This video I will explain mutual fund terms which every beginner should know. First one is a mutual fund. A mutual fund is an investment where many people put their money together and that money is invested in different financial assets like stocks, bonds or government securities. A professional called fund manager manages this money. Now we will see the real life example. 100 people invest 5000 rupees in a mutual fund. So total money becomes 5 lakh. This money is invested in different companies and assets. If investments grow, all investors benefit. Second one is NAV. NAV means net asset value. It is a price of 1 unit of a mutual fund. When you invest in mutual fund, you buy units, not individual stocks. Now we will see the real life example. If the NAV is 20 rupees and you invest 2000 rupees, then you will get 100 units. If the NAV later increases to 25 rupees, your investment value becomes 2500 rupees. Third one is SIP. SIP is nothing but systematic investment plan. A SIP means investing a fixed amount regularly, usually every month. Instead of investing a large amount at once, you invest small amounts consistently. Now we will see the real life example. If you invest 2000 rupees every month, then that is a SIP. Over time, your money may grow through long-term investment and compounding. Fourth one is lump sum investment. A lump sum investment means investing one large amount at once. Now we will see the real life example. Instead of investing monthly, you invest 50,000 rupees in one single payment. Both SIP and lump sum are common ways to invest in mutual funds. Fifth one is a fund manager. A fund manager is a professional who decides where to invest the mutual fund money. They study the market and choose investment like stocks, bonds, and government securities. Their goal is to generate good returns for investors. Sixth one is portfolio. A portfolio means the collection of all the investments inside a mutual fund. It shows where the fund's money is invested. Now we will see the real life example. A mutual fund portfolio may include shares of technology companies, bank stocks, and government bonds. This mix of investments helps to reduce the risk. Seventh one is diversification. Diversification means spreading money across different investments instead of putting everything in one place. This helps to reduce the risk. Now we will see the real life example. Without diversification, investing all money in one company. If it fails, you lose everything. With diversification, a mutual fund invests in many companies across different sectors. If one company performs poorly, other investments may perform better. Eighth one is expense ratio. The expense ratio is the fee charged by the mutual fund company to manage the fund. This fee covers costs such as fund management, administration, and marketing. It is usually a small percentage of your investment. Now we will see the real life example. If the expense ratio is 1%, then if you invest 1 lakh rupees, then the annual cost would be 1000 rupees. Ninth one is returns. Returns are the profit you earn from your investment. If the value of the mutual fund increases, your investment grows. Now we will see the real life example. Amount you invest at the start is 10,000 rupees. The value of your investment after some time is 12,000 rupees. So your return is 2000 rupees, which is nothing but the profit you earned from your investment. Tenth one is risk. Risk means the possibility that the value of an investment may decrease. Mutual funds reduce risk by diversifying investments, but risk cannot be completely eliminated. Now we will see the real life example. If stock markets fall, the value of some mutual funds may also temporarily decrease. Diversification helps to reduce the risk, but it cannot be completely eliminated. Here you can see the summary of whatever we have discussed.